All right, let's wrap up stock talk there. Move right into our last segment here today. It's a light news on a Wednesday, guys, and those are days I love in the markets because you get to geek out and do stuff like we're going to do next, where you dig into the detail of potential trading strategy and all that kind of stuff. Jedi Options is our weekly segment where Coach Tyler gets to go into the risk graphs, into the implied volatility, into the options market, and kind of craft some stuff that he sees as interesting and kind of pitches two different ideas in the options market so we can compare them and talk about them. Tyler, what you got today for Jedi Options?
Yeah, so today's going to be a little more unique. It's really easy to find directional stuff, credit spreads. Today we're going to play in the land of volatility. This discussion will dovetail nicely with the recent Trading Justice podcast on the volatility cycle. If you have not listened to that, make sure you go back and do it. Coach Matt was dropping dimes on that podcast, and it got me inspired, and it got me thinking about some trade ideas. So I'm going to show you, he told you, I'm going to show you, right? So what Matt told you on the volatility discussion about how vol works around earnings and the quarterly cycle, I'm going to show you an example of that today with Apple. And Apple is always a good one to talk about. It's super liquid. Everybody loves trading it. It's a good trading vehicle. Two things interest me here with this Apple chart. So from a technical perspective, Apple is at the same price it was in August of last year, right? It has essentially gone nowhere for, what is it, 10 months now? You know, and this is indicative of the whole growth. You know, these stocks got buoyed up after the pandemic, and now they're pausing. But if you look, I could draw a few lines here. I could draw a couple of trend lines, and I could pitch this as a symmetrical triangle, which is a neutral pattern, right? If we look closer, you know, we're approaching the apex of the triangle. Typically, as you get closer to the apex, a breakout is looming, right? Got to pick a direction here pretty quick. The other way that you could pitch this is more as just a sideways trading range, and certainly that is the case for the last month. And you could say, hey, Apple is falling asleep. You know, it's not going anywhere. Look at the moving averages. 20-day moving average, flat. Short-term trend is sideways. 200-day moving average, flattening. The long-term trend is neutralizing. The 50 MA has essentially been flat. Flat, flat, flat. I mean, it's neutral. It's neutral. So you either wait for this to pick a direction and do a directional trade, say, hey, break out, give me something bullish, right? Break down, break to here's the, okay, side note, terminology. You don't say break up ever, but we're always tempted to say break down. Technically, for those listening, they're both breakouts. It's just a bullish breakout or a bearish breakout. But I have a bad habit of saying breakdown.
I have the exact same issue. I say breakdown and breakout. Yeah. Breakout's up. Breakdown is obviously that's just how I've always done it. But you're right; they're both breakouts.
They're both breakouts. Yeah. Yeah. Anyways, so you wait for a breakout, go directional, or you see if there's something you can do here. So when it comes to volatility, let's talk about volatility for a second. You have actual market volatility, realized volatility, sometimes called statistical volatility, like how much the market's moving. And we can say right now the actual volatility of Apple is low. And it's probably going to wake up at some point because that's what stocks do, right? They get quiet, they rest, and then they move. They sprint, and then they take a breather. Well, the same thing is true with implied volatility, which is a reflection of option pricing. So when you look at the implied volatility, we are basically 6 weeks removed from the last earnings announcement, which means we're coming up on 6 weeks or so before the next earnings announcement. So we're in this special spot, kind of smack dab between two earnings announcements, where you had a higher IV going into the last earnings announcement. It's come down. We think we're troughing, and we think at some point between now and the next earnings announcement, you're going to get an upward move in implied volatility as traders start to get more excited about the next event, as they start to price in more potential movement, right? And so this would be the type of volatility scenario where I would be interested in buying options, right? In buying this cheaper volatility. So you combine the neutral price chart, the expectation that it's going to break out, up or down, with cheap options, And this is kind of the scenario where I like bi-directional trades, which I'm going to compare and contrast two of those here in just a minute. So low vol, expecting a move up or down, bi-directional trades. That's the analysis. I'm going to go build the trade. But any comments before I jump into that?
No, I love it. I think based on the IV rank, where we're at in the marketplace and seeing that compression pattern, it makes a lot of sense. You know, I brought up Apple the other day because I'm interested in this pattern developing, but it's got to break that range for you to see something, and so you'll get clarity out of that. So I like the premise here. So Ty, interested in see what you're going to build.
So we have a couple of choices. So when you look in the sandbox and you say, what are the long volatility bi-directional trades? You have a long straddle, that would fit the bill. You have a long strangle. You could do an inverted butterfly, or you could do an inverted condor, which we sometimes call the debit condor. So of those four, long straddles don't like as much. Inverted flies are okay, but I'm going to go with a long strangle versus a debit condor. Okay. So the easiest way to build this and follow along is you start with the long strangle because that's the simplest. Now, I need to buy options that are going to participate in a rise in implied volatility going into the next earnings announcement. Therefore, I cannot buy options that expire before earnings because they're not really going to participate in the IV build, because the reason IV is building is because there's this expectation that earnings is going to cause the stock to jump or something. Well, that doesn't impact options that aren't there when earnings comes around. So the next earnings announcement, the prior one was late April. So the next one's going to be late July. So I can't buy July options because I'm pretty sure they expire before earnings. So I got to go to August at least. And I don't want to go too far away because then it gets a little too expensive. So I think August will suffice. So we'll take a look at the August options here. A little pro tip, actually, if you look at the IV on the right-hand side here, you'll notice that the IV for the first couple of weeks and month is all around 24, 25. And then it jumps to 29. The reason there's a jump between July 23rd and August 20th is because earnings comes after July 23rd. So the August is the first cycle that's pricing in a little bit more volatility because it's baking in that earnings. So that kind of confirms my suspicion that earnings would be at the end of July. So I go to Aug 20, stocks at 127, which puts it between two strike prices. It's between 125 and 130, which is part of the reason why it's going to be easier to build a strangle, because I don't really have an at the money option. There is no at the money, not with this monthly. So I am going to build a long strangle where I buy an out of the money put. I'll just do the 125 here. And I buy an out of the money call, the 130 at the same time. And that's going to cost me $9.23. You see right here, it's a strangle. I'm long because I'm purchasing this. It's a debit trade. Why is this a bi-directional trade? Well, I did a bullish trade and I did a bearish trade. And together, it creates a risk graph where you profit if we go up or down enough. So if I right-click and analyze this, this is the basic structure. Clean this up just a bit here. Okay, so this is the basic structure of the trade. Now, $9, I mean, it is a little bit expensive, I suppose, but if implied volatility were higher, this might have been $10, $11, $12, $13. So the lower IV actually made this cheaper than what it otherwise could have been, right? If I were to hold this to expiration, I would need the stock to go up enough or down enough to pay for the trade. This call or this put needs to be worth $9 at expiration for me to at least recoup my cost. So that puts my break even about $9 above the call, which is 139, or $9 below the put, which is, I can't do the math in my head, 116. So those are kind of your expiration break evens. So you look at that just real quick to give you a, we're not going to ride to expiration, but if we did, this is how much the stock would have to move. And so I can set those slices to the chart. And basically we would have to get up here or down here. That is how much movement is being priced in the next, 2 months. Okay. So you say, well, I don't know. I mean, will it get above 140? Would it get below 115? That would be kind of a tough bet. But that's not really what I'm going to do. I'm not going to ride this to expiration. If I get out early, the stock doesn't have to move near as much, right? So ultimately, what we're going to try to do is maybe ride this thing, I don't know, a third of the way to expiration, half the way to expiration. You get a vol bump and a little bit of movement in the stock, and you should be able to generate a profit. And I'll model out the vol increase here in a second. Tim, any questions at this point?
No, I mean, August is 72 days out. Just want to point out a couple of things, though, as you're building this. Number one, the earnings date is going to be in the month of July, like most tech companies. And, Apple's going to be reporting that week when Google and those others, Amazon, I believe, reports the same week Apple does. So we've got this outside of that window. That's important because the vol build into the window is still going to benefit it, but we're far enough out to where we're not going to get vol crush by holding up to something like that. As a bi-directional pure place, because this is not just a vol build trade. You're looking for a potential breakout on the technicals too. So there's two different reasons you like this. You like the technical condition, which could generate a K trade scenario, but you also like the volatility build scenario, which will benefit as Vega increase or as implied volatility increases. Your Vega implication will help your option strategy. So I like some of the details. Just kind of wanted to reiterate some of those, but I'm good, man. I like the first step. So what are we comparing it against then?
Yeah, so the comparison, well, real quick, if you want to model out what the IV rise will do, you can do that down here. But I actually want to show something here, Tim. It's a little bit harder to show this on the IV rank. So let's add implied volatility real quick. I want to get an idea of how much I think it could go up. So IV right now is at the 25th percentile, or not percentile, it's just at 25%, okay? Let's say I think it could bump to 30 or maybe 35, right? It doesn't have to go up to 55. You'll be way lucky if it does that. But if you look at the last earnings announcement, it was around 35. The one before that, it was up around 50. Like you could average out around where the average level is into earnings. But I suffice it to say, I don't think I'm asking much for this to get up to 35, going into earnings. So I could say, all right, well, if I increase this vol adjustment 5%, it's going to lift the risk graph, right? So even if the stock doesn't move, which means it's still like right here, and I get this little bump in volatility, my Strangle, which I bought for $900, is up $200, which is like a 25% return. So even if Apple doesn't move much, there's how you model the vol increase. Okay.
And the vol increase can help offset the time decay, right? So that is an important part of that. Okay, good.
So the other, so what's choice B, right? This is choice A, and the incentive for this one is you have unlimited upside and unlimited downside, right? Like that's really the redeeming quality of the long Strangle and paying this arguably higher cost versus the alternative. Is I got the unlimited upside. So if Apple just goes bonkers, up or down, right? Maybe we crash in the next 2 months. I don't know. Maybe we crash and Apple goes down to $110. You've got unlimited profit potential with this particular trade. Okay. All right. So the alternative would be something cheaper. I don't want to pay $900 because when I think about the risk here, I don't know if I'm going to hold this till maybe, let's say I hold this for a month. Okay, as we're maybe even July 15th, as we're getting closer to earnings. If the stock doesn't move, I'm probably risking about $300. If vol doesn't change, Apple just takes a nap for the next 5 weeks, I'm probably losing about $325. Even though I paid $900, I'm probably risking about $300. Well, I want something that's cheaper / less risky. So I think there's a lot of ways you could do this, but to make it simple, a Debit Condor is nothing more than a long Strangle, what I just built, but you're going to sell a further out of the money put and a further out of the money call against the ones that you purchased. So when I build this trade out, we bought the 125 put, we paid about $4.80. I'm going to sell. Oh, you could sell the 110 and do a 15-point spread, or you could sell the 115 and do a 10-point spread. I think I'm going to do a 10-point spread. Okay. So I'm going to sell the 115 put against the 125, which effectively is a bear put spread. And then I'm going to sell the 140 call against the 130 call, which is effectively a bull call spread. So you're doing a bear put and a bull call at the same time. That's another way to think about it. The software is going to call this an iron condor, but it's a debit condor because you're buying it, you're not selling it. So if I analyze that, you're going to see that I still have this embedded strangle here. The difference is now I have these wings. And so I've capped how much money I can make because I've done spreads instead of just long call, long put. In exchange, I got paid a bunch of money when I sold those out of the money calls and puts, and that reduced my cost. So this is $5.81 instead of $9. Cut my cost by about 40% or so. And I still have decent upside, though. My max gain is $400 instead of unlimited. So now I'm risking $581 to make $400. And my break evens are closer. The stock doesn't have to move as far either on this trade as the other one.
Now, debit cons are a very popular strategy with Coach Gino over at Tackle Trading. We'll talk about that in just a second because he loves these. So if Gino was here, he'd be like geeking out about the debit con because you do reduce the cost. It changes the nature of the math. There's another thing that happens here that I think if you open the price slices, we could highlight a little bit as well. You're doing that visually with the risk graph, which is fantastic. But those theta rates are going to change, right? I mean, when you have the straight long options, you have more pure option Greeks in there. Pure delta, pure gamma, pure theta. Whenever you start to spread options, you start to mitigate some of the inherent risk within the option strategy itself. And that debit con is just going to have a lower theta rate. You're not going to get the big upside potential. You don't have unlimited gains with the debit con, but it's a trade-off. It simply is a trade-off. Straddle, pure play, debit con, reduced cost, reduced math behind the play. I like both choices here. Obviously, the debit con, it's got some subtle differences, and some of those differences are in execution as well, Tyler. Getting filled, getting in, exiting the trade, breaking it down leg by leg. So I would put that as an advanced strategy for any trader, quite frankly, one that anybody can learn, but definitely from an execution standpoint, you got to have some more experience. It's an interesting idea from both standpoints. Let's bring Coach Matt and myself back in here. Matty, which one do you like? What do you think here in terms of straddle or debit condor?
I like them both. Obviously, the debit condor, like Tyler says, it's kind of like, okay, if I'm looking at a directional position, do I want to do a call trade, like a single call, or do I want to do some type of risk adverse strategy like a bull call spread where you're bringing in a little bit of cash flow, offsetting the risk, obviously limiting the return there as well. And that's a bull call spread is a wonderful, wonderful way to make a directional position a little bit more conservative. The debit condor, same type of discussion, right? You take the aggressive bi-directional play in the straddle or the strangle, and you simply sell something against it to bring in a little bit of cash flow. You offset the theta decay by bringing in that cash flow. You also offset the volatility build too. And so you're basically limiting the risk a little bit. Personally, I like them both, obviously, but personally, when you're talking about Apple, and if you'll go back to Apple's chart here, I like the position Apple's in. I like the technical position Apple's in for a bi-directional play. You got a very clean resistance area right there at the 50-day moving average, which coincides with the previous level of resistance. You got a pretty good support level that has built right there around that 120 level as well. And so you got a little bit of K-trade analysis from a technical perspective. You also have, as we discussed the other day, some news coming out on Apple that could see an increase in volatility. But more importantly for me anyways on this one, I'm looking at that IV build here. And, Tyler, we talked about increasing volatility around earnings and what to expect. And I personally feel one of the easiest things in trading to project is the volatility build around earnings. And Ty, when you were talking about, volatility building into that, I believe you were saying 25 range, right? Can it get into that 25 range or 35 range? Or
35, yeah.
Yeah, 35 range. Yeah, I think that's very conservative, quite frankly.
It is. Yep.
Apple, I was thinking like Apple 40, 45, 50, right? So I think your projections on volatility build are very conservative, and that fits who you are as a trader, right? But I actually expect a little bit of an increase in the volatility build. And so because I like that, you're in a Goldilocks situation with the volatility build. Volatility is extremely low on Apple. You have earnings coming out, and I want to say, what is the exact date on earnings? Apple's rocking late July, right? Yep. So you're talking literally in that 6-week time frame right now, which is literally perfect timing when it comes to volatility builds, straddles, and strangles as you approach earnings. And so because of those, again, K-trade analysis, I do expect a little bit of price movement on Apple from K-trade analysis perspective, but most likely the volatility build, I want to have a pure volatility build here. I like the straddle. I like the strangle. I like the pure volatility build here.
Yeah. For the simplicity of just having the 2 long options, I actually agree with that. I think that it's just a pure play with the IV rank where it is. I don't think you have to mitigate theta and vega as much. You want the volatility thing. So if the volatility was in more of a mixed situation where maybe it already started to increase a little bit, Tyler, we felt like we were missing some of the build into it. The Debit Con is a real nice way to get the bi-directional component of it in, to where you can still play the K-trade type of analysis from the chart perspective. But I would prefer the straddle. I don't think the cost reduction is enough to give up the potential upside if you do catch the bigger run or the better IV build, personally. But it is more aggressive to play the pure options. Ty, which one would you lean towards? Yeah.
Well, yeah. So just to illustrate for the folks there, so the Strangle has a vega of 44, which means you're making $44 per 1 point increase in implied volatility. So what Tim and Matt are saying is that they like the fact that that's got the bigger vega. When you look at the Debit Con, the vega is only 12.5. So you've really hedged the volatility exposure. You're still long vol, you're just not long near as much. So I don't know that I have a strong opinion on this one. I don't mind either trade. It is interesting that the point you make that it doesn't reduce the cost maybe enough to want to cap the gain. So you're 923 versus 581. So it's 342 cheaper. Yeah, it's about 37% cheaper. But see, here's the deal. I mean, if you're comfortable, if you model out on the Strangle and say, okay, let's say worst case, I ride this to July 14th.
21st, yeah.
Or July 21st, yeah, whenever it is. I'll put 21st there. I mean, you get no vol build, you're down 390. Odds are you're going to get some movement and some increase in volatility. As long as you are comfortable with the exposure, I have no problem with the long Strangle here. None whatsoever.
I think it's one of those scenarios where it's like, yeah, both are good. Which one do you prefer? Yeah. I prefer the pure volatility build, but I would not have anything negative to say to anybody who's like, I can limit my cost by 40%.
Yeah.
Yeah. I think
I can reduce my risk. Right. I do think it takes a little bit of a different skill to manage a Debit Condor than it does a straddle strangle too, though.
Agreed.
100%. Execution is
4 legs versus difficult. 2 legs. I mean, Apple breaks out at 130, buy back the put and keep the directional call. That's a simple management decision. Same thing on support, by the way.